Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss House passes budget tax bill, reviewing Series I savings bonds, date the rate, marry the house, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are you, good sir?
Doing well. Yeah, just had my son's high school graduation yesterday, so that was a big milestone. Had some family come into town and things to go watch. It wasn't like when you and I were in high school. I mean, what was our graduating class, like 150 or something like that?
Sounds right.
Yeah, this was over 700. It seemed, when I started reading the names, it just went on, and I looked down and said, holy cow, they're only on the third row. Like, this is gonna be a long afternoon, but it was good. It was good. A lot of bright young people moving on to the next stage in their life, which is pretty inspiring.
Yeah, I think my college graduating class was smaller than that.
Yeah. Well, I know, and at Sac State they did it by department, and they even divided up the social science department because I was an econ major, and so it kept it to a much smaller, shorter ceremony, which is kind of nice.
Yes, sir. All right. Well, we got some great topics to dig into. House passes a budget tax bill. Let's dive right in. The U.S. House of Representatives narrowly passed a budget bill that included many tax provisions as well as provisions that impact other government programs. So what did we see as far as this go? I'd like to touch on, what's staying the same or remaining and not being removed, and what revisions are coming about.
Yeah, this is something I was even hesitant to write about, just because, this bill is now going to the Senate, where, it's looking like the Senate may pass a very different version of the bill. So we'll have to see. And then, what happens is you go through the reconciliation process where the House and Senate leaders kind of negotiate and try to come down to a final bill that they think can pass both chambers of Congress. So I'm sure there's still going to be a lot of changes that are going to come through, but there seems to be a lot of interest and a lot of questions, just given that this House bill has been in the news. So I figure we better get out in front of that. But as you said, most of it is just kind of more of the same. It's just extending a lot of the existing rules. So, big part of it is just making the 2017 tax cuts permanent, right? So the lower tax rates that we've already been experiencing for quite a while and have gotten used to, basically making those permanent. So not really a big change. It's also extending and expanding Section 199A, which is the reduced taxes for small businesses, as well as some investments like master limited partnerships and real estate investment trusts. Basically what that is when they lowered the corporate tax rate, they looked at pass-through entities. So things like S corporations, some LLCs, they're typically smaller businesses, as well as master limited partnerships and real estate investment trusts that are also considered pass-through entities. They looked at it and said, well, wait a minute, if subchapter C corporations, kind of your normal large corporation, are getting lower tax rates, what about where the business income passes through to an individual's tax return? And so they added that Section 199A that gives you a deduction for qualified business income. Is kind of this complicated calculation, but in essence, lowers the tax rate on those business entities, even when they're being reported on individual tax returns. So that was a big extension. But again, really, that being such a big part of the bill, we're really not going to see any change from where the tax law has been so far.
Okay. What about, I know the bill also permanently increases the estate tax exemption. So what what is that when it comes to the estate tax as far as the exemptions and the amount and such moving forward?
Yeah, so again, also a pretty minor change. Right now, the estate tax exemption is $14 million per person. So that's basically the amount that you can gift or leave to your heirs at death without paying the estate tax, right? So all of us have a $14 million like lifetime credit we can use against that tax. The new bill will restart it at 15 million, so bump it up a little bit. But then it's still going to be indexed for inflation as the previous law was. The previous law started at 10 million, it's up to almost 14. It'll this change will bump it up to 15, and then it will continue to grow with inflation. So that'll be 15 million that a person can gift or leave to their heirs. Married couples can combine their exemptions to shelter up to 30 million. Which, for most people is not going to be an issue, but for those with larger estates or potential estates, is pretty big because once you get over that estate tax exemption, the estate tax rate is 40%.
Mm.
So obviously, on really large estates, that can add up to quite a bit of money. So the fact that at least that's not going to go back down to a much lower level. Early in my career, the estate tax exemption was just 667,000. Then it was at 1 million for a long time, kind of went up to 5 million and then got bumped up to 10. So at least at a 15 million level, the vast majority of people are just not going to have to deal with the estate tax, and maybe more importantly, not to have to deal with just all of the procedural requirements of filing an estate tax return, which really is quite cumbersome.
Yes, it sounds like it. I know one of the hot buttons that was discussed was tax relief on tips and overtime. What ended up coming to fruition with that?
Yeah, and this will be an interesting one to see if it survives the final bill, but at least in the bill that the House passed. So it'll eliminate tax on tips for those who work in professions where tips are customary. So that's going to be, as always with these things, devil's in the details, right? What professions will be included, but also have to have income of less than 160,000 annually.
Hmm.
So higher income taxpayers would not benefit even if they're in maybe work at, I don't know, a really high-end restaurant or something where tips are customary, but the average ticket size is really large and they're making a lot of tip income. However, the tip income will still be subject to Social Security and Medicare taxes. So the income taxes would be eliminated, but not the Social Security and Medicare taxes. And then also the House bill will eliminate federal taxation of income for work that workers get from working overtime.
Hmm.
That'll also be kind of a tricky one, right? As to how that will work. There's already in most states laws on the books where if you work overtime, you get an increased rate of pay. And now if that's, not taxed, how exactly are they going to report that and make that work? And so, we'll have to see. I have a feeling even if that were to make it through in the final bill, it's going to come down to probably volumes of IRS regulations. Since typically Congress punts to the IRS to say, okay, now you write the regulations as to how this will actually work. There probably will be volumes and volumes that we will have to go through to figure out what the details are exactly.
It sounds like it. Oftentimes, when budget bills are passed or going through the process, one of the big changes or one of the headlines is how will it impact the U.S. Deficit, and what are we seeing as far as this bill and any implications?
Yeah, so these bills get rated by the Congressional Budget Office, which is a nonpartisan group that basically goes through and runs the numbers. Although even that's a little tricky because, the way it's structured, there's rules as to how they can do the calculations, right? And then, Congress sets the rules as to how they can do the calculations and then games those rules, to get the results that they want. But the CBO estimates that this bill will increase the U.S. deficit by 4.3 trillion over the next 10 years. They're only allowed to look out 10 years. But again, most of that is just from making the existing tax law permanent. So it's not like that's 4.3 trillion in new money that Americans are going to see. in the form of tax cuts. It's really just an extension of the existing tax regime. And then, they say that they expect that it'll increase economic growth by 0.4%. So they think, potentially it'll increase economic growth a little bit, which will increase new tax revenue slightly, but looks like most of it is, if the tax laws were to revert to the pre-2017 level, obviously tax receipts would be higher. By extending those, they expect tax receipts to be lower than they would if the law was allowed to expire.
Gotcha. Now that it has to move along to the Senate, what is maybe some of the pushback that we're seeing around it?
Yeah, this is where it's going to get tricky. There's a number of influential Republican senators that have said they're really not happy with the bill, largely because of the deficit. They either want to see, more spending cuts to help offset the deficit numbers, or, possibly some reduced tax cuts. So we'll see how that goes. I mean, right now the Senate is split 53 seats to the Republicans, 47 to the Democrats. So obviously the Republicans don't have a real big, majority to work with. They're pushing the tax cuts through in a budget bill because a budget bill only takes a majority in the Senate as opposed to the normal 60 votes. Which would be pretty much impossible to get. So that's the strategy here. But even with only 53, seats, they really only have two Republican senators that they could lose and still get the bill through. And at least from what I've been seeing, there's definitely more than two Republican senators coming out pretty strongly against this. So it'll be interesting to see how the negotiations work in the Senate, what type of bill they may pass, and where that compromise might end up coming out. But given how things are proceeding, I think we're probably really not looking at anything coming together until the end of the year, because I think there could be a lot of back and forth here.
Yeah, and what are maybe some of the concerns about this bill moving forward? As far as that growing deficit, the government, continuing to take any kinds of loans of any kind. What are some of the ramifications that maybe are, key concerns?
Yeah, I mean, the financial markets also pretty clearly expressed disapproval for the House bill. I think the concern is the deficit, the debt and deficit, and the amount of additional borrowing that will be needed to fund the deficit spending. And I mean, this is just a broader theme that U.S. government really increased spending during COVID and really hasn't stopped. We've continued to spend at higher levels. A lot of the programs that were expanded that were supposed to be, temporary expansions have not been reined in. So that spending has continued to grow at a faster and faster pace, including, outgrowing the pace at which the economy is growing. So, we're starting to see that a little bit in elevated interest rates. And the risk is we could eventually, reach a tipping point where the financial markets really are saying, okay, we're not going to be lending as much to the U.S. government, or if we do, it's going to be at much higher payments. And as we've talked about in the past, I mean, we're already in a situation where interest on the national debt is one of the largest spending categories. At this point, it's second only to Social Security payments. So if the financial markets protest and interest rates increase, then that's just going to increase the interest cost and expand the deficit even further. So I think it is a real challenge, and unfortunately, I mean, what we've seen is within either party, they like to talk about the issues of the debt and deficit when they're not in power, and then when they are, suddenly it's not really a big concern because they want to push through their agenda rather than tackling some of these harder issues that at some point we will need to tackle. Unfortunately, it seems Washington doesn't really take it on until it's a crisis.
Right. Absolutely. Anything else you want to add before we jump to reviewing Series I savings bonds?
Well, just as we said, I think there's going to be a lot of changes, so we'll keep updating, keep people posted as there's new pertinent information.
All right. Well, let's dive right into reviewing Series I savings bonds. Current composite interest rates on Series I savings bonds are 3.98%, comprised of a fixed rate of 1.1% and an inflation rate of 1.3%. So, what does that mean?
Yeah, so Series I bonds were really popular back in 2022 when
Hmm.
inflation was really high and they were paying had a 6 month inflation factor of 9%, right? And people looked at that and said, "Oh my gosh, you can lend to the U.S. government and get 9%. That's such a good deal." And in this newsletter and on the podcast, we kind of sounded the alarm and said, "Whoa, whoa, that's not the full story. You're
Right.
getting a 9.3%." Inflation factor, but the fixed portion is zero. So in essence, the only rate of return you're gonna get on this going forward is just inflation. And as inflation comes down, that inflation factor will come down. Well, here we are, the current, inflation factor is just 1.43% for 6 months. So that's basically, around a 2.86% rate of return for the year, which is much lower than you could get on other US government debt, right? I mean, a lot of US government debt is paying 4% or higher right now. So not having that fixed portion really is a negative. Whereas new bonds maybe aren't paying as much, but as you said, it's got the fixed rate of 1.1%. So at least you're going to earn 1.1% over inflation. So what we're seeing is, oddly enough, now the newer bonds look more attractive than the older bonds,
Mm.
right? The older bonds, maybe you got a little bit higher return up front, but now you're getting a much lower rate of return going forward, and it's really not competitive. So the point that, Daryl that wrote this article was making was, there is a time where you might buy these bonds and kind of hold on to them and think, oh yeah, they're fine, but you may want to review them and look at it and say, okay, have I met the holding periods where I could, cash these out, cash them out early before they get to the end of the term, but not pay a big penalty, because cashing out some of those older bonds that where the fixed rate was zero or really low, for a newer bond that looks more attractive, could make sense.
Yeah, well, what about that importance, how this plays into diversification? We talk about the importance of that, but also short and long-term implications when you're looking at your investment portfolio.
Right. Yeah. Yeah. How well diversified you are. There's a lot of, obviously many options in terms of fixed income or bond type investing. Right. And then also, tax management. Right. Government savings bonds can create some challenges as it comes to taxation, just in terms of the rules. So it may be that not only can you get a little bit better rate on some other types of government bonds as opposed to the government savings bonds, but you also may come with more favorable tax treatment.
So the fixed, my understanding is that yes, you want to look at all the different factors around the various interest rates, but the fixed portion is probably where you got to keep your eye on, at least concerning long term. Am I understanding correctly?
Exactly. Yeah. The inflation factor is what people focus on in the short term. And that's what happened back in 2022 when there was kind of a lot of media talking about how great that looked. But over the long term, really what you care about is the fixed portion. And that's what was lost in the conversation, right? In 2022, the fixed portion was zero. And so over the long term, you would look at that and say, this does not look real attractive, even though the inflation factor might be high at the moment. So yeah, I think, people need to look at it that way as, okay, this short term is getting a lot of people's attention, but what's the long term factor? And in this case, pay more attention to that fixed rate.
All right. Anything else you want to add before we jump to the next topic?
Well, people may have some questions about managing their holdings, what the tax implications would be. Of course, that's what we're here for. We're happy to go through and do that cost benefit analysis.
Let's take a look at Date the Rate, Marry the House. I just love this title. This is another great title. But what do we mean exactly when we say date the rate, marry the house?
Yeah, and I'll have to give Daryl credit for this one as well. He loves all these little financial catchphrases, right? And likes to use them. It's something that I guess has been a more common way of describing the fact that a house is a long-term commitment, right? When you buy a house, it's like marriage. You're going to be planning for the long term. I think the historical average is people stay in a house on average 7 years. But I think that's getting longer and longer with interest rates really low. People are hesitant to, give up their low interest rate mortgage. So they're staying in houses longer. Whereas a mortgage is typically a much shorter commitment, and we definitely saw that years ago when interest rates just kept coming down, down, down. People kept refinancing. So a lot of times you'll have multiple mortgages during a period of home ownership. And I think this is fitting right now because mortgage rates are fairly high, right? The 30-year fixed rate was right around 6.75%. So it's down a little bit from where it was, but still a pretty high rate. And a lot of people are looking at that and seeing that home prices really haven't budged, right? They remain fairly elevated because of low supply. And they're just not, they're kind of waiting for the right time period, right? Either our home value is going to fall, our mortgage rate's going to come down, and kind of holding off on making a buying decision. And what we're pointing out here is, if everyone's waiting and interest rates come down, it could cause a real spike in demand for homes, and you could see home values go up. Whereas there's the potential to, get in when home values have been flat for a while, and then have the option of being able to refinance the mortgage down the road, should interest rates fall.
Yeah, it's a really interesting time. I was thinking about this the other day. Where I live in my community is pretty, good demand neighborhood, and there's two homes that have been on the market for quite a while, and that when this came out, I was like, this has to be a situation of interest rates and why these two homes are not moving. I actually went looked through them. I was curious, seeing, oh, what did neighbors do, the different layouts and floor plans, and they're just not moving.
Yeah, and I think part of it is that interest rate, right? People just thinking, oh, I'll wait for interest rates to come down, or maybe like in your neighborhood, people would be looking to move up,
Hmm.
right? But maybe they want a little bit more space. Maybe they want community that's maybe feels a little safer for the kids to play out in the street, that type of thing. But if they're sitting on a mortgage that's below 3 or below 4%, you know, can they afford to move up and pay that higher interest rate? Um, but these are the times too when houses are sitting for a while. You may have more flexibility of finding that right house, right? Because again, this is a long-term commitment. You want to make sure it's the right house for you and that it's the right fit. And yes, it may, cost a bit more in the short term, but there may be an opportunity to benefit, should interest rates come down. Let's say the next time we go into a recession, typically when longer term interest rates drop, that may create an opportunity to refinance at that point. Whereas if you wait and suddenly there's this increased demand for housing, are you going to find the house that is really the right fit? Or are you going to end up, compromising and jumping into something that maybe is not what you would have selected otherwise if you had more time to be patient and really look around at the house that was right for you.
Yeah, I would like to speak real quick to the listener. That maybe is looking to be a first time home buyer here. Um, just the simple numbers when we think of it, we go, oh well, my parents have a 4.1% interest rate, and right now they're 6.7. Well, that's not a huge difference, but it is.
It does make a big difference on the payment. Yeah, absolutely. And under current tax rules, there may not be as much benefit from being able to deduct that interest as there was, years ago before the 2017 tax cuts. Um, but I think those are all things worth exploring, right? Running those numbers and saying, okay, what's the real additional cost here? And then if interest rates were to fall, what could that look like? Obviously, you want to make sure that it's affordable and that you can make it work at the current rate just in case. You don't want to be, completely dependent on needing interest rates to come down. But you also don't want to, make everything related to just that one factor. Too often it seems housing goes through these boom bust cycles, right? Where everyone's kind of waiting and they're happy renting, or they're happy in their maybe starter home with their low interest rate. And then once, their friends start moving, or they see younger family members start moving, and they think, oh, well, now I need to do that. And then it's okay, everybody's moving all at once, right? I think to a degree we saw that during COVID. The younger generation statistically were very happy renting. And then when COVID hit, all of a sudden they all wanted to buy and are saying, why are housing prices going up so much? And why can't we find anything? And why is everything a bidding war? Well, if you had thought ahead, and been one of the earlier ones in your cohort to buy when they weren't as much in demand, you would have just really had your pick of the litter. But by waiting and seeing what the herd's doing, and then feeling like, okay, now I want that as well, you're behind, and you're not going to get as good of a deal. You're not going to have as many options.
Yeah, absolutely. Anything else you want to add before we jump to the Plan Solutions Incorporated Office Bulletin Board?
Well, again, I think it's worth, running out those numbers and seeing what the tax implications are, what the, property taxes. I mean, that's one of the benefits of if you get in early while prices are lower, property taxes may be lower. In some states like California, where we have Prop 13, that can be huge savings over the long term. So you want to really weigh all of these considerations, not just be focused on where current mortgage rates are.
All right. Well, let's take a look at the bulletin board. We got one item pinned up there this week. Mr. Armour, what is it?
Yeah, well, as we talked about, so I just went to a graduation yesterday for my son, but also Carter graduated from Sacramento State University with a degree in financial planning. So, he had been working part-time during the spring. But he finally graduated, took a short vacation to celebrate, and now he's going to be working full-time. And then we also have Matt Young, who interned with us over the summer. He graduated from Oregon State University. So he plans to travel with his family a little bit over the summer. He's studying for the Certified Financial Planner exam, which he wants to take coming up. But then the current plan is he'll start full-time August 4th. So Plan Solutions team is growing, and we're going to have two bright, young, motivated young men that are joining the team. So that's pretty exciting.
That is, and that must be for you. And I know you and Shannon, were college classmates and friends, and have really taken the reins at Plan Solutions. So it must be pretty neat to have two young men come in, mentor them, see them through this journey too.
Yeah, it's a real feeling like things are coming full circle, right? And you can give back some of the benefits and opportunities that you were given. So yeah, it's exciting.
When did we become Obi-Wan? We used to be Luke Skywalker.
That's right. That's right. I think I told you, what movie was it the other day? Oh, it was a movie based on a book that I read as a young man, and it was kind of these people working in the Forest Service, and there's the kind of impetuous young man, and then there's the old ranger, right? That's trying to teach him everything and keep things operating. And I came across it the other day on Netflix while I was sitting with my wife and said, "Oh, I want to watch this. I haven't seen it in years." And after watching it, I thought, it's really funny. When I read the book and when I watched the movie many years ago, I really related to the young man. And I said, and now I relate to the ranger. it's I can see all the challenges he has trying to manage and keep things together and get the work done and all of that, right? And so, yeah, it is funny how our perspective changes over time.
Absolutely. Well, I know in addition to you having a graduate in the family, one other team member did there as well.
That's right. Yeah, Michelle's daughter and my son are in the same class, so at the same graduation. And in fact, her daughter was one of the speakers and did a great job. So yeah, her daughter is graduated, and she'll be attending San Diego State University. So that's exciting too.
Yes, it is. Absolutely. Well, congratulations to you, Michelle, and the whole Plan Solutions family on two new additions coming in. That's absolutely awesome. Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, it's warming up. Hope everyone enjoys the upcoming summer, and don't forget the sunscreen. that's my public service announcement. Don't forget the sunscreen.
What was it when we were kids? I watched too much G.I. Joe, and knowing is half the battle, right?
That's right. That's right. And, I mean, obviously you say that, but, just with sunburns and things, but it seems like, more and more people I know dealing with skin cancer, having to go to the doctor more and more. So, yeah, it is something that's, I think, easy to slip your mind, especially early in the summer, right? When you're not in the habit, but it is important.
Yes, it is. Absolutely. All right. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. If you're listening on Apple Podcast or Spotify, please leave us a rating, a review, and follow as well. And if you want to follow along to a visual form of the podcast where Chase and I have this discussion, and you want to see the personal financial review, we have a YouTube channel. You can go to youtube.com/@Plan Solutions and find us there. And if you have yet to subscribe to the personal financial review, send Katie an email and get subscribed today. That's KATIE @plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast. Plan Solutions is a registered investment advisory firm.